Getting older in America isn't as simple as it used to be. You've worked hard your entire life, saved what you could, and planned for a comfortable retirement. But what if I told you that the system is designed to drain your savings, limit your healthcare options, and leave you financially vulnerable when you need stability the most? The truth is, thousands of seniors in the US are falling into financial and legal traps every single day, losing their homes, their retirement funds, and even their ability to access proper medical care. These aren't just rare horror stories. They're real dangers that most people don't even know exist until it's too late. In this video, we're exposing 5 shocking truths that every senior in America must know. From hidden Medicare costs to nursing home loopholes that can take everything you own, these are the things no one is warning you about, but you absolutely need to understand. If you want to protect your savings, secure your healthcare, and make sure your retirement is truly yours, hit that subscribe button now. This could be the most important financial and legal advice you hear this year. You've spent decades working, saving, and preparing for a comfortable retirement. You've done everything right, or at least that's what you've been told. But what if I told you that your savings might not be enough? What if the financial security you thought you had was being silently drained by hidden factors you never saw coming? This is the reality for millions of seniors in America. They retire expecting their savings, pensions, and Social Security to cover their expenses, only to find out, too late, that the system is working against them. Rising costs, inflation, hidden taxes, and unexpected expenses are wiping out nest eggs at an alarming rate. One of the biggest threats? Inflation. Prices are rising faster than most people's retirement savings can keep up with. The cost of housing, medical care, and even basic groceries has skyrocketed in recent years. A dollar saved 20 years ago is worth significantly less today, and that trend isn't slowing down. Even if you've built a solid retirement fund, inflation can erode your purchasing power, leaving you with far less than you anticipated. And then there's taxation on retirement income. Many seniors assume that once they retire, their tax burden will decrease, but that's often not the case. Social Security benefits can be taxed, IRA and 401k withdrawals are taxed as regular income, and required minimum distributions, RMDs, can push you into a higher tax bracket than you expected. What you thought was your money might actually belong, at least in part, to the government. But what about pensions? A steady pension sounds like financial security, but not all pensions are as stable as they seem. Many companies and even some government agencies have underfunded pension plans, meaning there's a real risk that your pension could be reduced or disappear altogether. If you're relying solely on a pension without additional savings, you could be walking into a financial disaster. Then there's the rising cost of living. Beyond inflation, certain unavoidable expenses, property taxes, home maintenance, insurance premiums can drain your savings faster than you realize. And if you need long-term care in the future, you may find that the costs far exceed what you've set aside. Nursing homes and assisted living facilities can easily cost $5,000 to $10,000 per month or more, and Medicare does not cover most long-term care expenses. So how can you protect yourself? First, diversify your retirement income. Relying on just Social Security or a pension is a risky move. Consider investments, annuities, or passive income sources that can help you keep up with rising costs. Second, plan for taxes. Understanding how your Social Security, IRA, and pension income will be taxed can help you structure withdrawals to minimize tax burdens. Many seniors make the mistake of withdrawing too much at once, only to find themselves in a higher tax bracket and losing more of their money than necessary. Third, adjust your budget for inflation. The amount you need today may not be the amount you need in 5 or 10 years. Make sure your retirement plan includes built-in flexibility to account for cost of living increases. And finally, don't assume Medicare will cover everything. Many seniors are shocked to discover that Medicare doesn't cover long-term care, dental work, hearing aids, or vision care. Having a plan for these expenses, whether through supplemental insurance, an HSA, or a long-term care policy, can prevent devastating financial surprises. Retirement should be a time of security and enjoyment, not stress and financial hardship. But the truth is, If you're not actively planning for these risks, they could catch you off guard and leave you struggling. Do you have a strategy for protecting your retirement savings? Share your thoughts in the comments. It might help someone else avoid these common financial traps. You've worked your entire life, paid into the system, and now that you've reached retirement, you assume Medicare will take care of your healthcare needs. That's what you were told, right? That once you turn 65, the government will cover your medical expenses, giving you peace of mind for the rest of your life. But what if I told you that this is one of the biggest misconceptions seniors in America face? That Medicare, the program you thought was designed to protect you, actually has gaps so big they can leave you drowning in medical debt? Every year, thousands of seniors fall into financial ruin because they assumed Medicare would cover everything, only to be blindsided by enormous out-of-pocket costs, denied claims, and gaps in coverage they never saw coming. The truth is, Medicare is not free, and it does not cover everything. In fact, if you don't plan properly, you could end up paying more for healthcare in retirement than you ever did while working. Let's start with one of the most common myths: that Medicare covers long-term care. It doesn't. This is one of the most devastating financial traps seniors fall into. Many assume that if they ever need a nursing home, assisted living, or in-home care, Medicare will step in. But the reality is, Medicare only covers short-term rehabilitation stays, typically up to 100 days after hospitalization, and even then, only under specific conditions. After that, you're on your own. If you need long-term care, whether due to aging, disability, or dementia, you either pay out of pocket or rely on Medicaid, which requires you to spend down almost all of your assets before you qualify. That means that unless you've planned for long-term care costs, your entire life savings could be drained in just a few years, leaving you with nothing. Then there's the issue of routine medical expenses that Medicare simply does not cover. You'd think that something as essential as vision, hearing, and dental care would be included, but they aren't. Need a hearing aid? Not covered. Need new glasses? Not covered. Need a root canal or dentures? You're paying out of pocket. And these aren't just minor inconveniences. Hearing loss, poor vision, and dental problems are directly linked to cognitive decline, falls, and other serious health risks. Yet Medicare does nothing to help cover these costs, and many seniors don't find out until they're already struggling. Even when it comes to covered services, Medicare is far from free. Many people assume that once they enroll, they won't have to pay anything for doctor visits, hospital stays, or medications. But the reality is, Medicare comes with premiums, deductibles, and copays that can quickly add up. Part A, which covers hospital stays, is usually premium-free for most people, but it still has a deductible of over $1,600 per hospital visit. And if you stay too long, you'll start paying daily fees that can drain your finances fast. Part B, which covers outpatient care, has monthly premiums, copays, and a deductible. And if your income is high, you'll pay even more. Then there's Part D, the prescription drug plan. Many seniors assume their medications will be affordable under Medicare, only to be hit with something called the donut hole. This is a coverage gap where, after reaching a certain spending threshold, you have to pay a large portion of your medication costs out of pocket until you hit catastrophic coverage. For seniors on expensive prescriptions, this can mean thousands of dollars in unexpected costs every year. And let's not forget Medicare Advantage plans, which promise extra benefits but often come with hidden restrictions. Many people are lured into these plans because they advertise coverage for vision, dental, and even gym memberships. But what they don't tell you is that these plans often have limited provider networks. That means that if your doctor or hospital isn't in the plan's network, you could be paying significantly more for care or be denied coverage altogether. Some Advantage plans also require pre-authorizations for treatments, meaning an insurance company, not your doctor, decides whether or not you get the care you need. The reality is, choosing the wrong Medicare plan can cost you thousands of dollars and even limit your access to critical health care. Many seniors sign up for plans without fully understanding how they work, only to find out later that they made a costly mistake. They pick a plan based on low premiums, not realizing it comes with higher copays and fewer covered services. They assume they can switch plans easily, only to find that once they develop serious health conditions, they're stuck with limited options. So what can you do? The first step is understanding the gaps in Medicare before they catch you off guard. Don't assume that because you have coverage, you're protected from high medical costs. Research Medicare Supplement, Medigap plans, which can help cover deductibles and copays, and be careful when choosing Medicare Advantage plans, making sure they actually provide the coverage you need. Next, plan for expenses that Medicare won't cover. If you're not setting aside money for dental, vision, and hearing care, you could be in for a rude awakening. Look into health savings accounts, HSAs, before you retire, or consider insurance policies that can help cover long-term care costs. Finally, don't go through this process alone. Medicare is complicated, and one wrong move can cost you tens of thousands of dollars. Work with a trusted advisor or do extensive research before choosing a plan. The fine print matters, and making an informed choice now can save you years of financial stress later. Medicare was supposed to be a safety net, but if you don't navigate it correctly, it can become a financial trap. The system is full of loopholes, costs, and limitations that can leave you without the care you need when you need it most. If you're still watching, leave a like. It helps spread this critical information to more seniors who need to hear it. You've spent your whole life building financial security, saving for retirement, paying off your home, and ensuring that your family will be taken care of. But what if I told you that one wrong move could wipe out everything you've worked for? What if you or a loved one needed long-term care and suddenly found yourself paying tens of thousands of dollars every year, draining your assets faster than you ever imagined? This is the harsh reality for millions of seniors in the U.S. The cost of nursing homes and assisted living facilities is skyrocketing, and most people don't realize how financially devastating it can be until they're already trapped. The worst part? Many assume that Medicare will step in and cover these expenses. It won't. And by the time they realize their mistake, it's often too late. Let's talk about the numbers. Right now, the average cost of a private room in a nursing home is over $100,000 per year, and in some states it's even higher. Even a shared room can cost $7,000 to $9,000 per month. Assisted living facilities, which provide a lower level of care, aren't much cheaper, with costs ranging from $4,000 to $7,000 per month. Home health aides, an option for those who want to stay in their homes, can still cost thousands of dollars per month, depending on how much care is needed. If you or a loved one needs long-term care, how long will your savings last? Many seniors find themselves depleting their retirement funds within just a few years, selling assets and making desperate financial decisions to keep up with these costs. What's worse, if one spouse needs nursing care while the other remains at home, the financial strain can destroy any sense of stability, leaving the healthy spouse struggling to cover basic living expenses. Some seniors assume that Medicaid will cover their nursing home costs when the time comes. This is one of the biggest misconceptions that leads people into financial ruin. Unlike Medicare, which only covers short-term medical care, Medicaid does cover long-term nursing home stays, but only for those who meet strict financial requirements. Here's the catch. Medicaid has a spend-down rule, which means that before you can qualify, you must first exhaust almost all of your assets. In most states, this means reducing your total countable assets to $2,000 or less. Yes, you read that right. That means if you own a home, have savings, or even a modest retirement account, you'll be required to spend most of it before Medicaid will step in. And it gets worse. Medicaid has a 5-year look-back period, meaning that if you've given away or transferred assets within the past 5 years to qualify for Medicaid, those transactions could be penalized. That means your eligibility for coverage could be delayed, forcing you to cover costs out of pocket until the penalty period ends. Many families find themselves scrambling to sell off homes, cash in life savings, and make impossible financial decisions, all while dealing with the emotional weight of needing long-term care. Then there's the issue of your home. Many people assume that their house is protected if they qualify for Medicaid, But that's not always the case. In some situations, Medicaid can place a lien on your home, meaning that when you pass away, the state can claim the proceeds from the sale of your home to repay the cost of your care. This is known as Medicaid estate recovery, and it has left countless families without an inheritance, even after decades of responsible homeownership. So what can you do? The key to protecting yourself and your assets is planning ahead. If you wait until you need long-term care, your options will be limited, and you may be forced into financial hardship. But if you take action now, you can put safeguards in place to protect your wealth, your home, and your independence. One option is long-term care insurance. These policies help cover the cost of nursing, homes, assisted living, and in-home care. However, the best time to buy a policy is before you need it. Once you develop a serious health condition, you may no longer qualify. The earlier you purchase long-term care insurance, the more affordable your premiums will be. Another strategy is setting up a Medicaid Asset Protection Trust, MAPT. This type of trust allows you to legally transfer assets so that they are no longer counted when determining Medicaid eligibility. But because of the 5-year look-back rule, this needs to be done well in advance, not at the last minute. For homeowners, considering a life estate or an irrevocable trust can be a way to pass your home to heirs while protecting it from Medicaid recovery. This way, when the time comes, your home won't automatically be seized by the state. Some seniors explore hybrid insurance policies that combine life insurance with long-term care coverage. These policies allow you to access funds if you need care. But if you don't end up using them, your beneficiaries still receive a payout. Beyond financial planning, it's crucial to research nursing homes and assisted living facilities before you need them. Not all facilities are created equal, and some are notorious for hidden fees, poor conditions, and even elder abuse. If you or a loved one may require long-term care in the future, start visiting facilities now, reading reviews, and asking the tough financial questions. The reality is, most seniors will need some form of long-term care. Studies show that nearly 70% of people over the age of 65 will require long-term care at some point in their lives. Yet very few people are prepared for it. By the time they realize the financial burden, it's often too late to protect their assets. If you want to secure your future, you need to take action now. That means learning about Medicaid rules before you need them, exploring long-term care insurance while you're still healthy, and making legal arrangements to protect your home and savings. Nursing home costs don't just drain your bank account, they can strip you of your financial independence and leave your family struggling to pick up the pieces. But you don't have to become another statistic. With the right planning, you can ensure that your money goes where it belongs, to supporting your retirement, your health, and your loved ones. Do you have a strategy for covering long-term care costs? Drop a comment below. I'd love to hear your thoughts. You've spent a lifetime working hard, saving your money, and planning for a secure retirement. But what if I told you that there are people out there right now trying to take it all away from you? And not just criminals hiding behind computer screens. Banks, insurance companies, and even so-called financial advisors are finding ways to manipulate seniors and drain their hard-earned wealth. This is the silent epidemic of elder financial scams and exploitation. It's happening every day to people who thought they were being careful. It's not just about phone scams or phishing emails. It's about a system that takes advantage of seniors knowing that they may be more trusting, less tech-savvy, or simply unaware of the financial traps designed to steal their savings. One of the most common scams, the IRS or Social Security scam. You get a call from someone claiming to be from the IRS or Social Security Administration, saying there's a problem with your benefits or that you owe money. They may threaten you with legal action, demand immediate payment, or say your Social Security will be cut off unless you act fast. This is a lie. The IRS and Social Security Administration never call you out of the blue demanding payment or personal information. But in the panic of the moment, many seniors comply, handing over personal details or even wiring money to criminals. Then there's the grandparent scam. You get a call from someone pretending to be your grandchild, saying they're in trouble. Maybe they were arrested, got into an accident, or need emergency money. They beg you not to tell their parents. The voice on the other end sounds convincing, emotional, desperate. But here's the truth. It's almost never your grandchild. Scammers use social media to gather personal details and manipulate grandparents into sending thousands of dollars to criminals. But scams don't just come from strangers. Some of the biggest financial threats to seniors come from people they trust. Financial exploitation by family members is one of the hardest things to talk about, but it happens all the time. A relative might pressure you into lending them money that never gets paid back. They might gain access to your bank accounts, pressure you into signing over property, or even manipulate you into changing your will. Many seniors don't report these crimes because they don't want to cause family conflict, or they feel embarrassed that they let it happen. And then there are so-called financial advisors who prey on seniors. Some push high-fee investments that drain your savings, sell unnecessary annuities with huge penalties for withdrawal, or convince you to sign up for services that benefit them more than you. Not every advisor is a scam artist, but the financial industry is full of traps designed to take advantage of people who don't know how to spot them. One of the worst scams? Reverse mortgage schemes. A reverse mortgage can be a useful tool in the right situation, but many companies push these loans onto seniors without fully explaining the risks. You might be told that you can stay in your home for the rest of your life while collecting tax-free money. But what they don't tell you is that if you fail to meet certain conditions, your home can be taken away. And some companies deliberately structure these loans in ways that make foreclosure almost inevitable. Even banks, institutions that are supposed to protect you, have been caught in fraudulent practices designed to squeeze money out of seniors. There have been cases of banks opening accounts in seniors' names without consent, charging hidden fees, or even failing to report clear signs of financial abuse. So how do you protect yourself? First, be skeptical of any unexpected calls, emails, or messages asking for money or personal information. If someone claims to be from the IRS, Social Security, or your bank, hang up and call the official number yourself. Never send money or gift cards to someone claiming to be a relative in trouble. Always verify with another family member first. Second, protect your finances by limiting who has access to your accounts. If a family member or friend is handling your money, make sure there are safeguards in place. Set up alerts on your bank account so you're notified of any large withdrawals. Consider having a trusted attorney help you create a power of attorney agreement that protects you from financial manipulation. Third, be extremely cautious with financial advisors and investment opportunities. If someone is pressuring you to make a quick financial decision, walk away. Do your own research, consult with multiple experts, and never sign anything you don't fully understand. And finally, talk about it. One of the reasons these scams work so well is that many seniors feel ashamed or embarrassed when they fall for them. But the truth is, these criminals are professionals at manipulation. They know how to create fear, urgency, and emotional pressure. If something seems suspicious, talk to a trusted friend, family member, or even a professional before making any decisions. Elder financial abuse is a billion-dollar industry. Don't let yourself become a victim. Protect your money, protect your independence, and most importantly, trust your instincts. If something doesn't feel right, it probably isn't. Has anyone ever tried to scam you or someone you love? Share your story in the comments. Your experience could help someone else avoid being a victim. The law is supposed to protect people, ensuring fairness and security, especially for those who have spent a lifetime working, saving, and planning for their future. But what if I told you that many laws in the US actually put seniors at a disadvantage, leaving them vulnerable to financial loss, legal traps, and even exploitation? Every year, thousands of seniors lose their assets, homes, and financial independence. Not because they were reckless, but because they didn't realize how certain laws were working against them. These legal loopholes aren't widely discussed, but if you don't know about them, you could be walking straight into a financial disaster. One of the biggest dangers? Estate and inheritance laws that don't always work the way you think. Many seniors assume that when they pass away, their assets will automatically go to their children or loved ones. But without proper estate planning, your wealth could be tied up in probate court for months or even years. Probate fees, legal expenses, and court delays can eat away at what you intended to leave behind. And in some states, even if you have a will, certain debts and legal claims can take priority over your beneficiaries. Then there's the issue of joint accounts and unintended consequences. Many seniors add a trusted child or family member to their bank accounts, thinking it will make things easier when they pass away. But what they don't realize is that doing this can expose their money to that person's creditors, divorce settlements, or even lawsuits. In some cases, the added person can legally withdraw money from the account without permission, and once the original owner passes away, those funds don't necessarily go through the estate. They belong to the surviving account holder, whether that was the intention or not. And what about medical debt and end-of-life care costs? Many assume that once they pass away, their debts will simply disappear. But creditors can and will go after assets left behind for family members. Medical bills, unpaid credit card debts, and even certain types of loans can be deducted from your estate before anything is distributed to your heirs. If proper legal protections aren't in place, your family could be left with little to nothing. Another legal trap? Insurance policies that don't protect you as much as you think. Seniors often pay into long-term care insurance, life insurance, and health insurance plans for decades, assuming they'll be covered when they need it. But many policies have fine print that allows companies to deny coverage, cancel policies under certain conditions, or pay out far less than expected. Some seniors find out too late that their long-term care policy only covers a fraction of nursing home costs, or that a slight paperwork error disqualified them from receiving life insurance payouts. Then there's Medicaid's estate recovery program, which many seniors don't even realize exists. If you ever need long-term care and rely on Medicaid to cover it, the government can recover those costs from your estate after you pass away. That means your home, savings, or any remaining assets could be taken to repay Medicaid, leaving nothing for your heirs. And let's not forget predatory legal practices. Some law firms actively target seniors, convincing them to sign up for unnecessary trusts, questionable estate planning services, or expensive financial products that do more harm than good. Others push seniors into costly reverse mortgages without fully explaining the risks, trapping them in loans that could lead to foreclosure if they don't meet certain conditions. So how do you protect yourself? Knowledge and proactive planning. If you haven't already, create an estate plan with a trusted attorney, one who specializes in elder law. A proper estate plan isn't just about having a will. It includes protections like a living trust, power of attorney, and advanced healthcare directives that can prevent legal headaches and ensure your assets are distributed according to your wishes. Make sure you understand the fine print in all your insurance policies, whether it's long-term care, life insurance, or any coverage that will impact you in retirement. Don't assume you're covered. Get written confirmation of exactly what is and isn't included. Be cautious about who has access to your financial accounts. Adding someone to your bank account or property title might seem convenient, but it can have unintended consequences. Consider using a financial power of attorney instead, which gives someone the ability to manage your finances if necessary without putting your assets at immediate risk. And most importantly, stay informed. The legal landscape is constantly changing, and what you don't know can hurt you. Many seniors don't realize the risks until it's too late, when legal loopholes leave them or their families struggling. But with the right precautions, you can avoid these traps, protect your money, and secure the future you've worked so hard to build. The laws aren't always designed to work in your favor, but if you take action now, you can make sure they don't work against you.